Hello and welcome everybody to our annual Noble Fireside Chat. Over 28 years as a fiduciary, we've endeavored to bring our value partners into the living room with who we deem to be the foremost minds of hospitality, as well as global thought leaders. If this is your first Noble Fireside Chat, then we look forward to having you experience our live and in-person version very soon, which is truly a living room that feels more like a family reunion. Good, passionate people. We've got great food, there's cold beer, and deeply enlightening conversation. And as we think back a few years ago, our dear friend Arne Sorensen, who last week sadly lost his battle with pancreatic cancer, was with us. And professionally, as CEO of Marriott International, Arne more than doubled the company's geographic footprint, annual revenues, and including shareholder value. But as a friend, mentor, and brother to me, he was simply a giant of a human being. The picture you see here is of Arne with nearly 3,000 Georgia State University students and hospitality industry leaders for a speaker series that bears the name of My Immigrant Father. The series helps to share the intimate and diverse personal stories of icons and their families' journey of struggle, perseverance, commitment, and faith in realizing the American dream. Arne most certainly led a life that mattered, and we are going to profoundly miss him. Joining me today for seemingly weekly conversations on business, strategy, family, love, the speaker series, and our fireside chats, and known to so many of you, are two of my dearest friends and closest advisors, Chris Nassetta and Mark Elliott. Chris, of course, is president and CEO of Hilton, a position he's held since 2007, major strategic partner of Noble. Hilton is one of the world's foremost travel companies, 18 leading brands, 119 countries, representing approximately 1 million hotel rooms. Noble was founded in 1993 with our very first Hampton Inn. However, Chris and I actually forged our bond a few years after that, when he was an entrepreneurial real estate investor building a company called Host Hotels, which under his leadership became the largest hospitality REIT in the world. Mark Elliott is president of Hodges Elliott, serves as their strategic leader of a firm that has a number of different business lines, hospitality being their largest. HWE has sold more hotels corporately and Mark more hotels than any other individual in the United States. Over nearly 30 years, Mark has personally sold and or financed more than 1,500 hotels, representing nearly 300,000 rooms and with a value of more than $50 billion. Our team at Noble has been a direct beneficiary of his thoughtful and pragmatic research, thoughts and guidance, his invaluable expertise, and his genuine care and grace. Mark and Chris, welcome, my brothers. Thank you so much for joining us. I know we would like to be together with one another, but here we are. And I think our group is going to be very interested in a combination of data, research, thoughts, perspectives. Chris, from you on a global basis, trends that are happening. There's fundamental questions about the extent and the pace of the lodging recovery. And so what I thought we would do is, Mark, why don't we go through some of the research, and then we can just start our conversation there and continue. For those that are in our audience, you see a chat function. Unfortunately, you're too used to this by now, so you know how to operate it. I'll be paying attention to questions, and we'll keep this as lively as we do in person. So let's take it from here.
Great. Thanks, Mit. So the slides, about 20 slides, and we really cover 3 topics. One is, what does the recovery of the lodging industry look like? Does it recover completely to its previous levels of performance? Secondly, what is the hotel capital markets and investment recovery look like? And then third is some information and statistics on the particular sector of select service in which Noble is focused on. And Mitt, can people ask questions as we go, or how does that
Yeah,
work on Zoom?
I have the chat box open on a separate screen here. So as I get them, I will help allow us to pause and answer as we go.
Okay, great. And Mitt and Chris, I think we're just going to use this as a springboard for our dialogue between the three of us as well, right? So
Sounds great.
So the first slide is probably the most controversial, and Chris and I have been debating it for more than a week, and we keep moving it around. But
Mark, I think that we've sort of finished the debate, right? I'm right, you're wrong. Is that
exactly.
we conclude?
We can
Chris, you have the data.
Start with that.
Yeah, but Chris, you have the data.
I have a million, as Mitt just said, I have 1 million rooms in 119 countries and all the data that goes with it to sort of support my philosophy. But no, I'm kidding, Mark. I generally, agree with the chart that everybody's looking at, and I think we're already starting to see the business progress in the early stages of this recovery. And I think right now, we're sort of in between numbers 1 and number 2 with what I would describe as a smidgen of number 3. But the bulk of the recovery so far has really been in leisure, and I would say sort of, value-based or mid-tier type of leisure, which is more number 1. But that is reasonably rapidly sort of shifting. Obviously, the slope of the recovery, I'm sure we'll get to it, has a lot to do, as everybody would imagine, with the slope of the vaccination process and the ability to get to herd immunity through the broader exposure and vaccination. I said to Mark and Mitt, one of my very, very close friends is the COVID czar for our new president, President Biden, somebody I've known a long time, have, tremendous amount of respect for and trust in, and have been having an interactive dialogue. And I think it is fair to say, notwithstanding, an administration view, which I'm sure they'll stand by, that by July, there's going to be more supply than demand. I actually think it's going to be sooner than that based on the data and what I'm hearing. And I think there is an expectation that is getting set to be able to outperform in that regard. So my belief is, as you get to the late spring and certainly the summer, you're going to be in a very different form of recovery because of significant enhancement to mobility, which is going to very quickly move you into number 2 in Mark's chart. I think number 3, and I think the group side of it, which are 4 or 5, which is what Mark and I were arguing a little bit as good friends. I think the small groups are going to recover first. We're actually seeing that happen, and I think you will see a big upsurge if all goes according to what I described in the vaccination in small group business in the second half of the year. Again, nothing like what a run rate would have been in 18 or 19, but a far cry from where we were. And then I think you're going to see a progression, as Mark shows on the slide, of sort of a grind up in all the sectors, with the large groups sort of lagging, not in terms of booking patterns, but in actualization of business. But I think, generally, I think we agree. Mitt, it was because Mark, made me disagree with him. I should have started with a thank you for having me. Mitt, you said way too many kind words about Mark, for sure. But no, kidding about both of us, but I'll speak for myself about me. But Mitt and I go back a long way. Mark and I go back a long way. It's a relationship with Mitt and Noble that I cherish. Mitt's somebody that I've looked up to, that I viewed as a friend, a partner, a brother, as we always refer to each other. And so thanks for thanks for having me and letting me be part of this. And thanks for what's been, a great relationship, and particularly through these last 12 months. I think we've all been sort of a support structure for one another. But the good news is, back to recovery, I think we see, my own view, strong view, is we see the light at the end of the tunnel. We're still in the tunnel, but we're getting a lot closer to being out of it than when we got into it.
Great, thank you, and I echo all the kind things that Chris said to Mit and the Noble. Greatly appreciate the relationship. Just for those who are watching here, just to define some of these, low density leisure would be markets like Charleston, Savannah, Key West, Sonoma, Sedona, Napa, those kinds. High density would be Orlando, Vegas, Anaheim. And then business transient is the much debated sector, which is, how quickly does it come back? And it's already coming back. And you see that particularly in select service hotel numbers, which are performing better than full service numbers. We'll see here later, but it will come in phases and waves. And the big debate is, does Zoom disrupt any part of business transient? And our slide deck will hopefully address that, and then followed by group. So we can probably move to the next slide bit. And then James Bullard from the St. Louis Fed actually articulated this well early in the pandemic, probably in May of last year. And the question was, if we're going to go into a recession, which we did, and what is that going to mean? And he made a point, which is that we have a health crisis, not really an economic crisis. We had a strong economy going into this. And then it's going to be flooded by between 13 and 15 trillion dollars of both fiscal and monetary policy. So as soon as the health crisis is over, the economy will kind of roar back, extremely quickly. And that would be consistent, even with the, pandemic of the Spanish flu. It was, following, World War I and the Spanish flu, but then we had the Roaring '20s for a decade. And so, from an economic perspective, I think the stock market is obviously forward-looking and believing that we're going to have a strong economy post-pandemic. And the question is there any disruption, or does the lodging industry participate equally?
Maybe kind of comment on that, not to be argumentative with Mark on every slide. I agree. And that isn't his point, it's Bullard's point. I agree with that. I think in our industry, you heard my view on like second half of this year, frankly, I think will surprise to the upside. But I do think, to get back on our feet and get back to demand levels that are consistent with where we were like 17, 18, 19, which were all very strong demand years, it's going to take some time, because while this was definitely brought on by a health crisis, it has become an economic crisis, not for all sectors and all companies, but for a lot of companies. And a significant part of the underlying demand in our business is business travel, one way or another, either group-related businesses or individual business travelers. And so those businesses, when they're through the health crisis, many of them have to sort of get back on their feet. They will. We're going to talk about it. My own belief is, as they always do, and we always do in the industry, we will get back to similar demand levels that we were at before. But it'll take, a period of time. It won't be a light switch going back on. You're not going to wake up in July when everybody says the all clear sign has been given on vaccination and have demand levels like you did in 19. I think you're probably going to have those, and maybe Mark, I think there's a slide coming up, so I'll stop there. You're probably going to have that more like 2023. So there is a period of time in our, to build back demand base, where I think we have to go through sort of an economic rebuilding.
Yeah. So I'll just make a comment to that, because I think, one part, you're finding there to be more enthusiasm in the public markets, right? What the recovery could look like, and basically forecasting a number of years of significant, quarter over quarter, year over year growth, which I think we all expect. But the reality is that the build time will still, take some time, right? We've seen this, in a number of crises over the last 30 years, none like this. And we know that the build time will take until 23, perhaps in some cases 24 for select service, and then perhaps longer for other asset classes, which, really, creates two things. One, how do you get through between now and then? And then how do you perhaps, find opportunities
Yeah,
between
I
now
was
and
going to
then?
say,
The build-up.
Mitt, for you, sadly, it's going to be painful for some, but from the standpoint of the investors on this call, for Noble, it's opportunity, right? I mean, if it flipped around, it was going to be perfect on July 4th. There wouldn't be as much opportunity. The fact that people are going to, that the business is going to build over the next 2 or 3 years is going to mean there are going to be a whole bunch of folks that are not in a position to get to the other side without some help. And that's sad because many of them are our owners and they're important partners of ours. But at the same time, that's an opportunity if you have capital to invest. That is the opportunity.
Right. And I think the industry consensus is that you won't have a T12 of RevPAR equaling 19 until, at least 23. So kind of going to Chris's point, which is, the strong recovery starts kind of at the end of COVID, July or, whatever the date is, but it will take time to build to get, all the travelers back on the planes and back in the hotels. But, we do think it'll recover fully for some slides that are coming up. But this is interesting. The slide there on page 4, only in January, we were at 300,000 cases a day of new COVID cases a day. And over the last week, it's averaged about 60,000. So literally in 1 month, the number of daily cases has dropped almost 80%.
Yeah, and same with hospitalization and the death rate, a bit on a lag, but same thing. I mean, the last week is stalled technically a little bit, but a week's data doesn't necessarily mean a whole lot. And obviously, the shots in arms are going up at a exponential rate.
So the virologists say that herd immunity starts to kick in at 40% and is kind of perfected at around 70%. And so everybody's doing different math on this. So we did our own simple math, which is 74 million of our population is below the age of 18, which does not make them immune to COVID, but definitely makes them less likely to spread it. And then 28 million people are known to have confirmed have had COVID. And the estimates are between 2 and 4 times the 28 million have actually had it. I'd probably take the lower end of that than the higher end. And then you have 44 million people that have had the vaccine doses, some of which have already had COVID, but most of which have not. So, based on the simple math, not counting the number of people that have had it that haven't been tested, we're at 146 million people that are basically immune or resistant to the virus today. So that's 45% of our population. So the beginning of the herd immunity is starting to kick in, and that's why we're seeing the big drop. And you go another 30 or 45 days, and going from what was 500,000 a day to 1 million a day to 1.5 million a day to 3 million a day, where we think we could be in the next few weeks. We could see the fall off of the disease in this country, and in Europe, which UK is ahead of us, and France is behind us, but it should all fall off reasonably quickly. And then it'll take much longer, obviously, in other parts of the world, like Brazil and certain countries in Asia, India, what have you. It's just large populations and more rural, hard to get to, but it'll take a longer period of time. And then one of the things, so this is the big question, is does business transient? People are comfortable that leisure will return and may actually be stronger going forward than it has been historically, that the group business will return because people need to meet and rebuild their corporate cultures. But will the business transient return to 100%? And this is probably the #1 debated topic in our industry. And pretty quickly, people get comfortable that the salespeople will get back on the road. Some salespeople will try to close a deal by Zoom, and their competition will go and have a dinner and out hustle them, and that'll happen one time, and then everybody will abandon Zoom from a sales process as far as closing out transactions, and we'll get back on the road. But the question is, could small corporate training and perhaps some engineering work be done by Zoom versus in person? And the challenge with it is that if any technical information is being communicated, so training in particular, Zoom is just not as effective, and we see that in our school system. And children, as you know, actually have higher IQs than adults. Your IQ actually diminishes over time. Your knowledge base increases, but your IQ, your ability to learn, decreases. So children have the greatest aptitude to learn quickly, and you can see from just some of these school districts that the Zoom experiment is, and we all know it from firsthand experience, is definitely deficient. And so that'll work its way through corporate life, not immediately, as Chris says. It won't happen in people won't come to that conclusion that Zoom's not going to be a solution to removing travel in the second half of this year. Some of the travel could take time, but eventually, and by that 2023 date, we think people will have run their experiments and will kind of conclude that all the reasons to travel previously exist and more.
Mark, flip the page, maybe. I wanted to comment on that, but I think the next page does a good job of that. Yeah, this is as Mark has said, this is the raging debate, right? It's less about transient leisure business, less about group ultimately on a lag, and a lot about business transient, and the view that, gosh, every one of us is doing this and everything else inside our company is this way, training and meetings and and the like, and nobody's going to need to travel for business anymore. And I don't believe that's the case. I think if you look at the things over history, I wasn't around for this, but you go back and study it, like when the phone was invented, I was around for like voicemail, the internet, telepresence, all these technologies, which now seem, of course, mundane, but in the moment were revolutionary, just like Zoom is revolutionary today. And what we saw in every one of those cases, and you can sort of, see the timeline, for some of that here, is that demand for travel, for business travel overall increased. You add to that globalization, which has been slowed obviously in the last year, but is not, in my humble opinion, going to slow broadly over the next decades. And the reality is what really has happened, and certainly in my almost 40 years of doing this, is all these new technologies, the advances in globalization have sped the world up, sped commerce up, and created more reasons for people to have to travel for business and travel for other reasons, some of that just to see the world. Now, it does create a substitution effect, and it has every step of the way. There are things that change, like when telepresence became a thing. I could speak for our company, but broadly across our customer base, certain types of business travel diminished as a result of that. But the net result was still, as the world sped up and globalization continued, that overall demand increased. People just substitute lower value trip occasions for higher value trip occasions. Again, this will be a debate. The reality is, because business travel will be weak for a while because of the economic issues caused by the pandemic, it will sort of support the theory that business travel has seen a secular shift. I do not believe it's true. I've had the debate. I've watched this for 35, 40 years. And the reality is I believe it is a cyclical decline, started with the pandemic, followed by economic impact as a result of the pandemic. And that as we get over the next 2 or 3 years, you will wake up by 23, 24, and demand for business transient will be greater than what it was in 17, 18, and 19. But there will be trip occasions, some of the reasons why people are traveling will be different. But building culture, collaboration, innovation, partnerships, joint ventures, all of these things that we do when these big businesses like the one I run, they cannot be done effectively in this format. There are other things that can be done effectively and will be done effectively that will free up more travel time to do things that deliver more alpha. I always kid, I said, it's really easy for the CEO of a company, to say, hey, we're going to cut back. We've learned how to do all this stuff virtually until your competitors are out delivering alpha and you're not, and everything changes.
It's also hard to create culture without the
For
human
sure.
interaction. And so I think about the three of us, in what we've done relative to the time that we've spent, the relationships that we've forged, the meetings that we've had face to face over multiple decades, learning to understand one another, trust one another, believe in one another, and then forge relationships and partnerships going forward. That seems very natural to a human being, right? It's how we meet the person that we want to go spend the rest of our life with, right? You just don't look at a screen and connect with them and say, okay, we're going to go do it. And so forging trusting relationships, building culture and the like, it's hard for a lot of people that have been shelter in place and been at home working for the last 10, 11, 12 months, perhaps, to think about how do we go from doing what they've done very efficiently. There's a Zoom from 7:30 in the morning to 8:30 in the morning. Then at 9 o'clock, there's another one from 9 to 10, and you just keep going on and on and on. But what it's done is, and talking to a number of my friends that are participating here on our Fireside chat and others, people are working longer than they did,
There are no boundaries. That's what I say to my team.
Right?
It's a boundaryless world. When my team in the middle of COVID, they started planning meetings Saturday nights at like 8 p.m. Zoom meetings, I said, what is wrong with you? Like, it's Saturday night. And yes, I know that we're in lockdown, but I actually have a family and I'm going to have dinner with my family. And no, we're not going to do a Zoom call Saturday night at 8 p.m. Let's have some boundaries.
Remember, we used to all be in the offices on the weekends, right? Because you didn't take a laptop home. And so the only way that you actually could functionally work is be in the offices. And guess what happens? You show up in a pair of blue jeans, and a shirt.
But it will take.
You've got tons of folks there, and that's where the relationships got created.
Right. It will take some time, which is why I'm a believer that it will go back to demand levels. But it will take some time, just like office reopenings. We had this discussion this morning with my executive committee, in hopes that by this summer we're fully operational. But people have formed all these new habits, some good, some bad, but they don't involve commuting and going to the office, and they don't involve travel. In addition to budget cuts because of the economic, impacts of the COVID crisis. So that's why I say it'll take till 23 or 24, because you got to get people back in the office. You got to get them back in those habits. You got to get the businesses back in motion for people to sort of go back to thinking about things a little bit, in a little bit more normal way. And they will ultimately, to your point, Mitt, realize that in order to deliver alpha, which means a better culture, better relationships, new partners, et cetera, they're going to have to do what they were doing before, and that is get out and communicate and interact and build relationships in a very personal way. And that's just the way that the funny thing is, we humans, we're not meant to do this, and we all know it. And anybody that thinks we are, well, I guess there's some of them out there. It's just humans. It's been studied for 1,000 years. Humans need humans, right? We need personal interaction, and digital is not going to isn't going to be an adequate substitute.
So interesting comment. We'll go to the next slide. I remember a number of different conversations. You show up, to your destination on a Monday or a Tuesday, and you have an afternoon meeting and you have a dinner. And then you go the next morning. There's a breakfast meeting. There's another meeting. You have a lunch. And then you either stick around for other meetings and dinner and spend another night, or you go home. And then you go back, and you're having a conversation internally. So, well, here's what we did. We had 3 meals. We had 4 meetings. Perhaps we went and did something fun. It's like, well, is this a business trip or is it a personal trip? And the answer is yes. The answer is yes. Right? Yes. Because you do business with people that you trust.
You build
trust. and you build affinity and you figure out how to do things by having these personal interactions. So very interesting in terms of the flywheel. I think we all remember when we either got our first, email account or cell phone email account, then all of a sudden the BlackBerry showed up, and then so forth and so on. And it feels like we just continue to add to the opportunities to do more in every.
I'm certainly hoping all of my competitors do not travel in the future.
Great. So page 8 is a slide. If you've been an investor with Noble for a long time, you've seen this slide or a version of it before. It's kind of the slide we say explains all things in the universe. But if you look at the blue bars, these are the annual increases in supply for the last 30 years, and the average annual increase is 1.9%. The gray brackets at the bottom is periods of growth, where you have RevPAR CAGRs over extended periods of time. And you can see it was 4.7 in the 90s, disrupted by the tech burst and the tragedy of 9/11 in early 2000s, followed by, kind of a return to the mean. So supersized RevPAR CAGR of 7.5%. And then a decade of RevPAR at, same store sales at 5%. That would have continued on if not for the global pandemic. We were obviously in a strong economy heading in. The growth could have lasted 11, 12 years instead of 10. It could have gone 26 years like the Australian or Dutch economies, right? We don't know how long it would have lasted, but it probably would have lasted a longer period of time. The most important data point on this slide is that the rate of growth for hotel supply is declining. You can see, in the 90s, it grew at almost 20%. In the mid 2000s, 15%. In the last decade, 10%. So if your rate of growth is in a secular decline and your demand is consistent, you're ultimately going to end up with pricing power in the industry that we've never seen before, which will make these RevPAR CAGRs in future decade actually grow higher than in the past. So pause there if Mit or Chris wants to make any comments.
No, I'm in violent agreement. I say, master the obvious. The laws of economics are alive and well. It's in our industry, like all industries, it's a matter of supply and demand. Supply, as Mark just pointed out in that chart, in this cycle was muted compared to prior cycles. So, part of the problem we've had going into prior declines, you can see on this chart in the 80s and the 90s, we went in hot, with much higher levels to the point where you got up into 5 and 6%. If you look at this last cycle, the cycle never got out of control, in part because the economics didn't support it, in part because it took a long time after the Great Recession to get capital back in the business to make it happen, a whole bunch of reasons, but it didn't happen. And so you went into this down cycle, that was caused by COVID, but that's turned into obviously the biggest down cycle in recorded history, in a reasonably good place from, supply. You didn't have huge excesses. And as Mark pointed out, it's going down. It's going to go down, in my opinion, precipitously. My guess is you will see some bars in that bar chart in the next few years that are going to look a lot like, the early mid 2000s and the early mid 90s. And that is going to be matched with what I believe will be a massive uptick in demand for all the reasons that we've already covered as we sort of work our way through the next couple of years. We could talk sectors later, but the select service is going to be certainly in the next 2 or 3 years a huge beneficiary of that for a whole bunch of reasons. It is to a large degree newer and better product. It is the mid-price product that people can afford, and you're still going to be dealing with some broader economic hardship that's out there, and so you're definitely going to have some trade down benefits that you see now for sure, and that I think you will see over the next 2 or 3 years. So, the basic fundamentals. I know we're going to talk about some of the macro stuff and valuation later, so I'll save that, which is really interesting as well. But I think the basic fundamentals for the industry, as hard as it is to say it with where we are right now, feel like they're set up. Mark, I think that you sort of said it, but I'll use, I'll be a little bit more bold. I think they're set up for probably the best run we've seen in our lifetime, or certainly one of the best runs, because supply being very muted and going down, and not having been overheated to begin with a very big demand curve. And the select service finds itself, I think, in an enviable position. Would you agree with that, Mark? That we're gonna, that RevPAR CAGR in the next 5 to 7 years is, once we get to terra firma, is going to outstrip any of these other numbers you've got?
I think that's right. I think you could actually see it, and believe it or not, actually maybe in the high single digits, because and there's been certain micro markets that have maintained for long periods of time high single digits. I think it could happen on the macro, because
part of it's math.
If you think about
Part
the
of
whole
it's
credit,
math too.
if you think about the credit cycle, who's the first banker to walk into a credit committee and say, after the global pandemic, let's go, finance and build a bunch of, finance a bunch of hotel development. It's just going to be much lower than previous cycles, because it's not just economic cycles now. It's this whole.
You will get down to net new supply of 0 to 1%.
Yeah.
Well, you'll get to less than half of the 30-year average, in my opinion, easily.
Right.
And that will be met by increased demand. And then it's a math. I mean, the mathematics of it are pretty straightforward. Now, you had to pay a big price in 2020 to have the math work in your favor. But, if we don't have a double-digit CAGR over the next 5 years, something's wrong. I mean, just because the math of how low we went.
Exactly. And then the stat that we kind of came up with is just, one of the two strongest sectors, in recent years in real estate have been multifamily and logistics. And yet, we have this dynamic where multifamily supply is definitely increasing. And in the last decade, you can see that multifamily supply as a percentage grew 50% faster than lodging. And going forward, if you're looking at the next decade at, a 5% or 6% increase in lodging supply, and, multifamily continues to grow, I think you'll have, much better pricing power dynamics in the lodging sector than perhaps any other real estate sector for the next decade. Then this is the piece about demand, and kind of the whole debate about, are there disruptors that will change hotel demand? And over my 36 years in the business, I've heard a number of prognosticators talk about that this is no longer going to apply, that hotel demand, what this graph shows is that hotel demand is 98% correlated to GDP. So if GDP is up 2%, hotel demand's up roughly 2%. If GDP is up 3%, hotel demand's up roughly 3%. So again, if you're growing at, the historic 1.9% supply growth, and you have, demand that's above 1.9, you have pricing power, going forward. If you think about this next decade, where you probably have GDP growth of at least 2% for the decade, and hotel supply, which is maybe a half a point or certainly below a point, you're going to have amazing, pricing power. And so, all the questions about disruption, whatever the reasons for the prognosticators to say that this graph is going to decouple, it hasn't happened.
By the way, Mark, I agree. They've been debating it. I've been debating that R squared with those prognosticators for my entire 40 years in the business, and they, with all respect, they've been wrong. And if you took this chart back 50 more years, which you can, you would see the same correlation at 98 or 99.
Yeah. And then we start to move into kind of, the current performance and how the sectors that Noble are invested in compared to other sectors. So, Noble's invested in upscale and upper mid-scale select service. And you can see that compared to full service, the sector has performed better or, less bad during the downturn. And you can see it even in the burn rates of the hotel REITs. Those that are focused in big urban large hotels have a much higher burn rate than those that are in select service. I mean, you can even see in some of the select service REITs, they've actually had positive operational cash flow in the last quarter or two, where all the full service REITs are continuing.
Yeah. And I would argue, Mark, that, and I sort of already did, that that's going to continue. On an absolute basis, performance is going to be better in the mid-tier. Now, some of those that own the big urban boxes on a year-over-year growth rate might show greater growth just because they're going from almost a zero base. They'll show infinite growth because many of them are closed. But, on an absolute performance basis in terms of rate, absolute RevPAR, this sector is going to outperform at least for the next couple of years.
So we've gone about 40 minutes and I've not seen a question yet, and this is not a bashful audience. So please feel free to jump in.
We must be.
You know what? I think they're used to being able to sit in a nice, comfy chair and have a cold drink. So it's a little unusual for us all. So
maybe we need to.
You're illustrating the reason why people aren't going to do this by Zoom next year. Where we doing
exactly? We need to be more outrageous and stimulate some questions.
So back to the things that you can't wait to not say anymore. Hey, can you hear me? Can you see my screen? Yeah, those are the things.
You're on mute.
This page 12 is an important page because it shows kind of how the investment cycle has worked in previous cycles, and then we can kind of grab on how to look going forward. So you can see from the great financial crisis, it took 54 months to get to a trailing 12 RevPAR that was equal to the peak prior to the crisis. And then for hotel transaction volume, it took almost 3 years for the transaction volume to return to previous levels. And then for pricing, and this is just a rough proxy on price per key, which is not a perfect graph because in every year you have different hotels that trade, but the basic vector, it took over 2 years. We think in the present cycle, there could be reasons for this to be elongated. It could take longer to go through the pipeline of the servicers and special servicers because they've been slow to foreclose because they didn't want to fund the operational negative. And then that will quickly turn, post-vaccine, and they'll put more pressure on their borrowers, and the borrowers will have be under, a tremendous amount of pressure from, basically the capital in front of their equity piling up. They've got reserves they have to replace, they have renovations they have to do. And so, that capital piles up, it puts ultimately pressure on them to transact. But the markets are forward looking, and you will have, values recover ahead of, performance.
I'll put a marker down on this thesis because I think this ties, when we get to our general session later, this ties to the opportunity set that's forthcoming. And as we describe the first new investment that Noble is making in this new cycle, it'll speak exactly to that as well.
Good. And then this graph, if you look at the far right and you see those small, very small, almost can't see the bars of transaction growth, you see why my business has been terrible for the last year. And which is, I don't know if this applies to anybody else, but this has definitely been reflective in our volume. But the point of it is, you have to have transaction volume really kind of increase and spike before you see large increases in valuation. So the window has opened to make good buys and will continue until you can get a robust increase in transaction volume. Until you have,
I mean, Mark, you said it, and you're on the tip of the spear. I'm not, in the sense of the transactional side, but obviously we see a lot of it within our portfolio. to your point about special servicers, the banks, forbearance, that was, something that people were very liberal with at the beginning of the pandemic. But we're sort of getting to the waning days of that flexibility. This is my impression talking to a broad base of our owner community. And some of them are well equipped to sort of belly up and, and rebalance loans and renew them. And some aren't, and they're going to work with some and they're not going to work with others. So I think, as you get into the next 12 months, 18 months, it'd be hard for me to believe you're not going to see a big uptick in transactional activity. I mean, we were looking at it, in terms of what we're already, starting to see in the last, couple of months relative to our change of ownership. And you're already last year, almost none. I mean, I think we were 80% off our normal change of ownership last year, which was astounding. But you're already starting to see it sort of return to normal levels. And our expectation is it's going to go well above normal levels. Again, sadly, because it just means that, people aren't in a position to by themselves sort of work themselves the other side. So my sense is that, that's happening, that's going to lead to price appreciation. The other thing and I think you have a slide on it, that's happening, that happens every cycle, having done this longer than I want to admit, is people, become afraid of hotel. Here you go. When things got as bad as they did last year, you have this real the bifurcation as between the different sectors. You also have your normal spread to treasuries gaps out in a big way because people are just really worried about the business in a crisis like this. But reality is, that all of those always revert back to the mean. The other thing that's going on is, if nobody's noticed, that we have been, for better or for worse, probably for the better for the moment, we have been printing money like drunken sailors here in the United States pretty much ever since the Great Recession. We never really backed out of printing money and quantitative easing, and now we've doubled and tripled down, and we're getting ready to do a bunch more. And so, there is a real fear. You see it in the markets. You guys are investors. You see it. There is a real growing concern over inflation. And so you put sort of a normalization of spreads, that occurs when people realize that the industry is recovering, and it normalizes with, a fear of, or, sort of an inflation, people wanting to hedge against inflation. And we're an awfully good place. In the sense that we could reprice not just every day. We used to say we reprice every day. Now with the revenue management methods, we can reprice every minute of every day. So that's a pretty good hedge against inflation. So I think that's a pretty good, sort of tide that will be coming in my opinion, that sort of forgetting fundamental. I think the fundamentals are, as I already described, they're going to be a good sort of wind in our sails. But from a valuation point of view, the things that people own when they wake up in 2 and 3 years are also going to get the benefit of these other macro trends in valuation.
Just to comment on the previous slide on volume, and you don't have to go back there, but just to comment on it. Since September, we've done 140 valuations, hotel valuations for servicers or special servicers, and only taken 5 to market. So it kind of indicates this pent up demand that's about to occur. I don't know if it's months or a year or 18 months, but eventually these loans work through, if they're in servicing and special servicing, today, and they're getting to the point that they need a valuation, that means there's stress there, right? They're trying to find out if they're in the money or out of the money from the lending perspective. So eventually, our normal conversion rate of valuations is somewhere around 50%. And so for it to be, below 5%, kind of indicates it's kind of building demand, a product that'll
yeah, that's interesting. I hadn't heard you say that data point. Consistent with what we saw in our change of ownership, by the way. Same kind of percentages, roughly.
Yep.
So page 14 just talks about the extraordinary yield and lodging compared to, all the cap rate compression you've seen of other sectors. So there's basically, this graph kind of tells me there's two ways to win in lodging. One is you buy it here, post-vaccine, and you have a high yield, cash on cash return, and you make money that way. And then secondly is if there is cap rate compression, which a lot are expecting to occur with, Jerome Powell continuing to say we're going to be dovish going forward for he's saying at least 2 years, could be longer. You could end up with 100 basis points of cap rate compression or more in lodging, which would create tremendous blended IRRs from both cash and capital gain. Cash flow. Yeah. And this just illustrates the spread. The spread 15 years ago was between 450 and 550 basis points, and has widened out to almost 700 basis points between the 10-year Treasury and lodging cap rates, and it always returns to the mean. So we could.
It always does, and it will again.
Yeah. So we definitely could see 100 basis points or more of cap rate compression once we stabilize. This goes back now to the last, kind of the third part of the discussion, which is to talk about the sector that Noble's invested in, which is this kind of mid-scale and upscale, upper upscale select service. And this is broken out by RevPAR by segment, 75 to 100, 100 to 125, and then the 150. And this gets into the number of hotels that fall into these RevPAR categories. So you can see that there's 5,500 hotels that a select service that are below $100, and that's really not the sector that Noble is competing in and looking for. Noble's really focused on the sectors at $100 or higher, and I think that's roughly about 5,000 hotels that are in $100 or higher RevPAR. And then this is the performance, and again, you see in the middle part of the page the colored graphs of the 75 to 100, 125, and this is over time, and you see the occupancy performance, and not a surprise, the higher RevPAR hotels are going to the higher occupancy. So once you get into the mid 80s in occupancy, because of Sunday night, you're basically running full most nights of the week, which then allows you to push rates much harder and faster, which is where the real profit in hotels occurs.
So again, I think the interesting part here is that so much of this, as we look forward, is not going to be linear, right? It's going to be market by market, segment by segment, street corner by street corner. The ability that when demand comes back, it's not going to come back for everybody. There's going to be winners and losers, unlike in times past where there's predominantly winners. And so having the ability to think about where occupancy can return, demand returns, but then also how do you price effectively, segment your business, and the like, become even more important today than they ever have been. And I think we'd all argue that they've always been really, really important as a specialist, in this space.
And then this graph, which is interesting about this, is that the higher RevPAR hotels, their growth in ADR goes back to the point when you get to that high occupancy, you can see that those higher RevPAR hotels, the growth rate in ADR accelerates faster than those at lower RevPAR levels. And I think it's a good kind of thought to keep in mind. And we talk to Noble about this all the time. It's a good thought to keep in mind as you're investing going forward, that some of these higher quality, newer, better located hotels are going to have more compounding of RevPAR, which obviously leads to a disproportionate positive compounding in cash flow.
The other thing that we're not talking about, but is sort of underneath all of this, and obvious in the strategy that Noble's picked, being in select services, the cost structures. I mean, as much as there's unemployment, abound, and you would think labor is abundant, labor is not abundant for a whole lot of reasons. You've got massive pressures on increasing minimum wage, which whether it's $15 or 10 or 12 or something that staged over time is likely to be happening on a national basis. And so the wonderful thing about select service is these are low labor model, high margin business to begin with. And I can speak on at least behalf of one piece of the Noble portfolio where we work together. The biggest body of work that's going on at Hilton is to take our mega brands, which are our select service brands, and re-engineer them. And we are largely through the process so that they are significantly higher margin businesses on a like for like basis than they were, when we went into COVID. Just sort of the necessity became the mother of invention in COVID. We figured things out. We were able to test things and push the limits and innovate in ways that really nobody in the industry has had to or wanted to. And it's led us to some pretty interesting ideas and conclusions. And so, the select service business, more than any other segments, are going to be a beneficiary both of, sort of being low labor, so sort of countering other pressures for labor costs to go up, but also the benefits of at least in the case of Hilton, the benefits of re-engineering the labor models to take even more labor out and drive even higher margins.
So, Chris, we share a love of many things together, and from how we enjoy each other's company, and you and Paige and Reshma and I and Mark, you and Lori. But one of those things on a professional basis is a real passion and a culture of innovation and technology. Can you maybe take that component? Because I know we've spent a lot of time together over decades as technology has evolved, but specifically, I think you and I was at your house, I think on February the 27th, I think it was the date of last year. And we were having this conversation, and we were literally at the precipice of this health crisis, but about how do we continue to bring technology and innovation to bear to drive profitability in these boxes. Can you talk a little bit about what Hilton, your desire for them to be a leader in this?
Yeah, I'm happy to, and I do remember that night. Boy, lots happened since. And of course, I'm going to say this, but I actually believe it. I think Hilton, it has been a leader throughout history. I mean, going way back, we were the first one to invent a reservation system, for the record. But, over the last 10 years since I've been here, we've been on a mission to be able to digitize and use technology to digitize the parts of the business that can be digitized and enhance the parts of the business on the physical side to make that part of the experience better with the use of technology. And so we've done a number of really important things, some of which are really boring, some of which are more exciting. One is to totally reinvent our tech stack so that it is a modern architecture that is open source, cloud-based, API, microservices based. So you can actually move the pieces around and innovate and plug and play and unplug very, very easily versus these big monolithic systems that everybody in our industry has had for literally, decades and decades and decades. And we've sort of led the industry, and, our environment is largely in that environment. So what has it allowed us to do? Well, as we were innovating in things like, straight to room, digital key, digital room selection, digital checkout, the connected room. So on your device, you can control all your audio, visual, lighting, HVAC, talk to the hotel with a messaging app. We had already developed all that stuff, right? We had deployed the first pieces of it, which are digital key, digital check-in and the like, because our belief was, that is what we all want. I say to our board all the time, what does everybody want? We want choice and control, right? We want it in the palm of our hand, because every other element of our life, we have choice and control in the palm of our hand. So our guests want the same thing ultimately when they stay with us. And so we've been on a mission pushing hard in that agenda for the last 5 years to be able to do that. And COVID, if you want, like that was all happening. We were doing it. Others in the industry weren't as far along, but they were doing it. And COVID just sped it up, right? I mean, COVID just digitized everything in the sense that we now we've had to rely on almost completely digital existence. So all of the wants and needs of our customers have just been, are on steroids. They just want what they want. They want it faster. They want more control. And now they're used to it because it's how they've been living. So we continue to push the envelope. And the idea is there are certain routinized things that are going on that, that can be done digitally better than people. Check in, check out, room selection, ordering room service, the temperature in your room, pre-ordering things, messaging when you have a problem. All of those things can be done better and more consistently digitally. It allows then a whole lot of access for our team members on the property and fewer of them. So because you can take labor out, but it gives them more data and information and more tools to then customize and personalize the parts of the experience that need to be physical, that aren't going to be digital. So somebody that, when you want, well, you can do this digitally too. When you want to connect to the local city that are going to be able to help customers personalize their experience. And so the idea is like, we're a business of people serving people. Mitt hears me say this all the time. It's not like not with Hilton. You're not going to have robots running the hotels in my lifetime. People come to our hotels for a lot of reasons. They always want the human interaction. But what we've done over the years is we have humans being robots. If you think about it, we have humans doing mechanical robotic things and actually not, engaging with customers. So the idea is really simple. Get the humans to be human, get the robots, get what can be digitized, allows us to take labor out, create far greater efficiencies, energy efficiencies, labor efficiencies, and the like, and it frees up the people to engage more personally in the experience with the customer when the customer wants to engage. We call it our whole strategy Phygital. Yep. For the record, physical.
It's a flywheel for profit, and it's a flywheel for potential.
It's a flywheel in the following ways. It reduces costs, it increases engagement and satisfaction, and drives share. So it should, if we do it right, and I think we will, it will drive higher market share and lower costs. So you'll make, higher margin, more money on the bottom line.
So we're going to hit these last 3 slides, Mitt, in probably 90 seconds, and then we can get to some questions because I know that that's important. But you can see that from $125 RevPAR and up over the last decade, you've outperformed the top 25 markets of all hotels in the United States and all hotels in general. And 100 basis points at this level of RevPAR CAGR can mean 300 basis points of spread operationally. Post debt, it could mean 500 or 600 basis points of additional profit. Compounded over time is phenomenal difference in your IRRs. So again, kind of really focusing on this quality assets that you're targeting. And then this just shows relative performance in 19, where the industry, had slowed a bit. You can see the top 25 markets in the U.S. at 2.9 or 3. You see, over 4% in the sectors of above 150 RevPAR, 3.4 at 125. So again, outperformance. And then again, you kind of see the ADR change. This goes to that pricing power. When you get to that high occupancy, you really can still price way ahead of the rest of the industry. And then lastly, you kind of see here 18 and 19, and you see the relative performance of those various sectors compared to the U.S. And it just kind of gives you another picture of how important it is to kind of be in those right markets and those right hotels. I think that's all of the slides, right, Mitt?
That is all the slides.
Good.
So let me go to the queue here for a second and a question from the group. there's been a lot of discussion around the future of, primary cities. And Mark, you just had a slide up, talk about top 25 markets, and clearly these urban city centers have had a really tough 2020, in terms of, people being in offices, business travel, and the like. What's your sense of the future of cities, recognizing that too, it's not completely linear, right? San Francisco and it's going to be different than New York. New York's going to be, different than LA, and so forth and so on. But can you give a broad geographic perspective of how you see the evolution of these, big cities against some of the newer cities that are clearly of high demand? Nashville, Austin, Salt Lake, Denver, Atlanta, Tampa, Charlotte, DC.
Sure.
So that's for both of you, and Chris. That's Mark, probably for you on one component of it, and Chris for you, obviously in terms of the data that you're seeing as well.
Well, I'll go first, and then Chris can correct anything I say that's incorrect. So, Wayne Gretzky had this famous quote, which is, "I don't skate to the puck; I skate to where the puck is going." And I think we are seeing a real secular shift in where business is moving to and growing. And that, we always had this kind of view in the lodging industry and other industries where, the big gateway cities would be dominant over the primary cities. And that was always the way it was going to kind of be. They would grow faster, they would price higher, and be stronger. But if you look at, downtown Nashville as an example, downtown Nashville has one of the highest ADRs and RevPARs of any city in the country, and the growth, and that's before Amazon's 5,000 jobs show up. It's before Oracle, who's likely to go there, shows up. It's before Alliance Bernstein has actually manned their office, a brand new headquarter office space. And so, I think these primary cities, Charlotte, Dallas, Phoenix, Tampa, Atlanta, Nashville, they're experiencing secular shifts, and you'll see it over the next decade where they will actually have much greater pricing power than they've had in years past. Not to say that New York's going to go away or Washington DC is going to go away. They're not, but these cities are going to see a profound difference.
I agree. I mean, I do think the rumors of the death of the big cities are premature. I think it's always, sort of human nature to trend line off the top that things will never never go down. And when they're at the absolute bottom, that the sun will never come up. And it feels like in some of the major cities right now where the bulk of the hotels are closed, it sort of feels like the sun will never come up. In New York and San Francisco and whole bunch of other, Chicago, a whole bunch of other cities where the big box hotels are literally not even open. But I do think for a bunch of reasons, as you get through the pandemic and over a period of years, those big cities will come back. The demand will come back in part because the infrastructure that's there already, right? There is, a lot of restaurants and all that are closed. They'll come back. They've got, convention centers that are bigger. They've got lots of hotels with larger volumes of meeting space. And I think we all sort of agree. I think we agree that, that business is going to come roaring back. And the reality is you've gone for a generation without a lot of meeting space being built, right? And if you see a world where that demand is increasing, it's got to go somewhere, and it's going to go to where the capacity is. So I think that major cities will be better than everybody thinks right now, honestly. But it's going to take a lot longer than it has in prior cycles. Having said that, I agree with Mark, though. There are that next tier of cities, I think, are where you're going to see greater disproportionate growth and disproportionate investment. That is then going to create an even more allow them to be even more competitive, because the economics are going to work better there, both because of the demand patterns in the short to intermediate term, but the cost structures in those markets, that it's going to allow them to build and renovate and just have better product over time. Whereas in some of the big cities, demand's going to take longer. The product isn't going to be as up to snuff. And let's be honest, you've got labor costs in the top tier cities that are largely organized that is much, much higher. And so when you put all that together, that labor arbitrage, and owners aren't making a lot of money, what happens? They don't reinvest a lot of money. And so that, over time, it makes it harder to compete, where you go to some of these, that second tier of markets where you're going to have newer product, better economics, both because while maybe the rates aren't quite as high as some of the major markets, the cost structure is so much lower. Your cash flow is going to be lower. You're going to have greater investment. And so markets like, some of the ones that Mark talked about, Nashville, Austin, some of those markets, Tampa, I think that they have an opportunity to really blossom. And I do think they will have greater demand growth coming out of COVID and far greater opportunity for cash flow growth.
Chris, there was a question that referred back, Mark, to your slide on the 10,500 or so select service hotels that were on, half of them under $100 RevPAR, the other half of them above $100 RevPAR. And Chris, the question was, headed your way, which is, so for those franchisees, assume that, on the top half of that bar, which are predominantly your franchisees, that have gone through this crisis of 2020, built these great hotels. How many, by the way, when you have your amazing Hilton conferences, how many people, how many franchisees are there when you have them?
It depends, but 5,000, something like that, typically.
So, and these are all,
Let's put it this way: we generally have to do it in a convention center or a stadium.
So you have these great hotels that have gone through this crisis, that you've allowed them to use their furniture, fixture, and equipment reserves. They've gotten forbearance, and now, as demand starts dramatically changing in 22 and 23. And to your point here, I think the question was, how do these hotels stay renovated and new, and where does that capital come from?
Yeah, unless that's something. In fact, I had a senior team town hall yesterday, and 15 minutes of the hour and a half were consumed by this topic. It's an incredibly delicate balance. As you and I have talked, we have given an incredible amount of grace and flexibility because we had to, because these owners are our partners, and they're the engine of opportunity and growth for us. And we have been trying to help them in every way possible through this crisis, and we continue to. And that's been relatively easy to do because our typical customers not really traveling. Expectations broadly of the traveling public are lower. And so you can sort of get away with this kind of flexibility on renovation, on lower standards on housekeeping, on lower standards on breakfast and food service altogether. You can get away with a lot because people know the world is upside down. But if I'm right, you get to the second half of this year and you start to see the burners, afterburners light up, and you start to get your core customer back that hasn't been out, but that is coming back and has the same expectation of that they had before they stopped traveling, and they start to see, wow, the rooms are getting ratty, or we're not, some of the standards have slipped. It obviously could cause significant problems, because in the end, my obligation to our owners is to long-term maintain the strength of these brands. I'm not doing anybody any favors by letting these brands get permanently damaged. We have the best brands in the business. I hope you agree, Mitt. But by statistic, meaning that every segment, our brands are the market share leaders. So you don't even have to be nice. I can prove it objectively that we have the best brands. That means people pay us the highest premium, and they pay us the highest premium because we have the best product we deliver, the best service, we do it reliably and in a friendly way, and that's what they want. And if we stop doing that and we lose those premiums, we've done a huge amount of damage to our entire ownership community. And so we have, it's a balance that we're gonna, but a delicate one. As we get back to more normal patterns of travel, we are going to have to start pushing harder for the return of a new normal. And that new normal is going to be, as I said, I think a higher margin business where we do things better and differently and more cost efficiently on things like housekeeping and, and breakfast and food and beverage. I'm not saying we're going back to what it was, but we're not going to be doing what it is, when things start to return to normal. And we're going to have the investment in the hotel. So what we are going to do is we're going to, as we always do, it's going to create friction, but we're going to have to put pressure on our owner community to keep up the system. Because as I say, while that may sadly not help some, my job is the many, not the few. And I have to watch out for the whole system, because if what we do is we let the brands get damaged as part of this process, everybody suffers. And so it's going to be tough. I said to my team, literally, I see a record. I said, brace yourselves. This is going to be, the next 12 months are going to be really hard. But it is going to provide opportunity, because there are a lot of, and by the way, they know they need to do it, right? Because what happens when they don't reinvest in the hotel? They lose their share. They're going to end up in a bad place anyway, right? Because competitively, they're not going to be able to keep up, and they have even more extreme problems. So what it creates is an opportunity. Like there is a huge demand for capital coming, a tsunami of demand for capital coming in the select service broadly, but particularly select service space in the next, let's say, 6 to 24 months. That is going to be all about reinvestment in the hotels, paying back whatever people had to borrow, to get through this. Rebalancing loans, because their loan to values are all out of whack, et cetera, et cetera, et cetera. And so I'm having these conversations every day, literally, with owners. And I'd say it's a bit early. Like they're all, some of them have the capital to get through, some of them don't. And they're all, everybody's sort of hoping, okay, I don't mean it, but I mean, a lot of them are hoping like the switch goes on, like July 1, woo, we're back. And it's just, as I think we've all agreed on this call, it just doesn't happen that way. And so they're going to eventually realize that they're eventually going to have to seek out capital, or they're going to take a problem that is a, sort of liquidity problem, and they're going to turn it into a solvency problem, right? Meaning they're going to take an asset where they had a lot of equity, and they're going to risk losing it all versus losing some of it.
Mark, we've got a minute left. Can you take 45 seconds and describe what Chris just mentioned, which is this friction that has existed before, not at this level, given RevPAR's down 50%, during this duration, and what that means, relative to a brand, the relationship with an owner, the license agreement that's signed, the lender that has the loan, default provisions, and how those pressure points kind of evolve to what this tsunami of opportunity that Chris just mentioned.
Yeah, well, that's the point, right? Is you're not a lone ranger when you're a hotel owner, right? You have a lot of constituency groups besides just your building and the customer who stays in those rooms, right? You have the brands, you have the lenders, and the customer has. I mean, the one thing that the hotel industry has done probably a good job, and a dramatically better job than the airline industry, is spoiling our customer, right? I mean, the hotel rooms that a lot of hotels, or most hotels today, are better than the homes we live in, right? It's like newer furniture, the TV's better, the bathrooms are modern, and the shower's nicer, and it's a great experience, which is fantastic. It gets people to want to get out on the road and go and visit and travel and do those things. But you have to maintain that, and it costs a lot of capital to do it. So if you go into the pandemic at the beginning of 20, so you have all of 20, all of 21, and then well into 22 and 23, and you've used your capital that you were saving in either reserves or what have you to pay debt service and to keep the lender at bay. The demand for that Chris's organization still wants those rooms renovated, and that capital has to return to the system somehow. So in addition to the checks you've already written, you have to now write more checks. Well, most of these hotels are owned in some kind of syndication where, you start to have to call capital, and I mean, I was just on a call yesterday with, a billionaire who's an investor in 3 deals, stopped funding capital. Like, he just stopped, right? And so all of a sudden,
We've got a
the
few
general
of those,
partner in
Mark.
this, huh?
We've got a few of those.
Yeah. And so all of a sudden, the general partner's partnership is panicked because, their big capital partner has just stopped. So, the brand's not going to stop demanding quality. The customer's not going to stop demanding quality. And the lender expects those reserves to be topped back up sooner than later. So all of a sudden, there's enormous kind of squeeze on the general partner and the ownership of the hotel. And it's going to force properties to market. People will take their marks, they'll take their losses, they'll return less capital to the billionaire, but they will move on.
But they won't lose. But they won't lose their asset.
They won't lose property. Then the other thing,
some of them, by the way, some of them are going to, sadly, because they're going to hang on thinking they can slide by. But most rational people are eventually going to figure out, hey, I gotta fix this, and I got to take my lumps.
Yeah, and to your point, Chris, you're going to be more tolerant in the middle of the pandemic than you're going to be post-vaccine, right? Post-vaccine, you're going to say, hey, things are getting better.
Well, what's interesting, and Mitt will be one of the guys doing it, as he should. That as much as we'll have an owner group that is not going to like that friction, we'll have a bigger owner group that is going to be forcing. If we're not doing it, it's going to force our hand. That's going to say, hey, I'm seeing all these other Hamptons or these Garden Inns or whatever that look bad, and you're dragging the system down. I mean, so it's, we get pressure on all sides. And honestly, at some point, if we weren't doing it, we'd get a lot more pressure on that side.
And lastly, and I know we've gone over the 45 seconds, but it's probably an important point. The other thing you're seeing is owners that are solvent, right? And they funded all their obligations. They own 20 hotels. They funded it, but now their checking account is down to 0, right? Like they've lost so much capital. As they look across their universe and say, you know what? I'm going to sell 4 or 5 hotels, even if I'm losing equity, just to get equity back so I have cash reserve and cash liquidity again. And so I can keep my other 16 hotels going and keep them solvent and what have you. And we have a major owner right now. And the guy owns, probably 25 hotels, and we're selling 4 of them right now in a package. We're probably going to sell 4 more. He's funded everything, but he's got to shore up his capital because he's got CapEx and obligations and accrued debt service that he's got to deal with in the coming years.
Chris, Mark, you have been such dear friends to me and to our entire organization, and both of your teams. It's a real blessing to wake up every day and get to do business with people that you love, and that certainly holds true for the both of you. Thank you so much for joining us. I can't wait until we're all together again, face to face, doing the things that we love the most. It's going to happen soon. Thank you.
Indeed it is. Thanks.
Good to see you,
Really
Chris. Thanks.
appreciate it. The feelings are mutual. Thanks, man.
Take care.
Good to see you, Mark.